Short selling is a fundamental mechanism in capital markets designed to facilitate price discovery and discipline over overvalued assets. Yet its structural architecture creates an asymmetric risk profile that can become lethal during periods of market stress. Unlike a long position where losses are capped at the initial capital invested, a short seller faces theoretically unlimited liability as a security's price has no ceiling. This systemic vulnerability is compounded by the mechanics of the transaction itself. The process begins with the locate requirement under Regulation SHO, where a broker-dealer must confirm the availability of shares before a short sale can be executed. Once borrowed, these shares are sold into the market, with the cash proceeds held as collateral. The short seller's objective is to repurchase the shares at a lower price to return them to the lender, pocketing the spread. However, maintaining this position incurs continuous costs. The cost to borrow, or CTB, is an annualized interest rate that fluctuates based on share availability. A sudden spike in CTBs, such as the rise from 34% to 195% observed in Beyond Meat in late 2024, serves as a live signal of constrained supply. Furthermore, Regulation T requires short sellers to maintain 50% of the transaction value as additional collateral. If the security's price rises, the short seller faces margin calls, requiring the injection of fresh capital or the forced liquidation of the position. This margin architecture serves as the primary mechanical trigger for a squeeze, transforming a directional bet into a forced buying obligation. In this environment, the liquidity of the security becomes the most critical risk variable for the institutional manager.
A short squeeze occurs when specific structural preconditions align to create a self-reinforcing buying loop. These include high short interest relative to the float, often exceeding 20%, and an elevated days-to-cover ratio, which measures the time required for all shorts to exit based on average daily volume. When these metrics are high, the market is crowded, and any upward price catalyst triggers a brutal mathematical cycle. As prices rise, short sellers incur unrealized losses, triggering margin calls. To close their positions and stop the bleeding, they must buy shares, which adds further upward pressure, triggering subsequent layers of margin calls for other participants. This cycle overrides fundamental valuations in approximately 40 to 45% of cases, proving that being right about a company's deteriorating health is insufficient if the market structure becomes trapped. This feedback loop is often supercharged by the gamma squeeze within the options market. When investors buy call options, market makers who sell those calls must hedge their risk by purchasing the underlying stock. This is a mathematical obligation known as delta hedging. The hedge is not static. As the stock price approaches the option's strike price, the gamma increases, requiring the market maker to buy more shares at an accelerating rate to remain delta neutral. The GameStop event of 2021 illustrated this perfectly. Short interest exceeding 140% of the float combined with massive retail call buying. This forced both short sellers and market makers into a simultaneous non-discretionary buying frenzy, driving the stock from under $20 to an intraday high of $483. The squeeze only concludes when the demand side is severed or the available float is exhausted. The fallout from a short squeeze carries both individual and systemic consequences. Data from 2022 to 2025 indicates that while short strategies can generate alpha, the 43% of trades that fail result in average annual underperformance of negative 24.1%. The collapse of Melvin Capital following the GameStop squeeze underscores the ruinous potential of these events. In response, the regulatory landscape is shifting toward increased transparency. The SEC's adoption of Rules 10c1a and Rule 13f2 now require more frequent reporting of securities loan data and institutional short positions. While intended to reduce opacity, this environment also creates systemic risks. The fear of being squeezed can suppress legitimate shorting, activity that leads to persistent overpricing and more violent eventual corrections when speculative bubbles finally burst. The 5 to 10-year outlook suggests that short squeezes will remain a permanent feature of the modern market,
particularly as zero-commission platforms and 0 days to expiration, 0 DTE options increase gamma-driven volatility. For the serious investor, the rational verdict is that liquidity and market mechanics are just as important as fundamental analysis. High short interest should be viewed as a double-edged signal. It confirms bearish sentiment, but also represents the fuel for a potential explosive rally. A professional framework requires monitoring cost to borrow and utilization rates as live instruments of risk. Ultimately, the short squeeze is a reminder that in a high-leverage environment, mechanical constraints will always override directional conviction. Managing position size relative to the tradable float is not merely a technicality, it is a prerequisite for survival in a market where overcrowded conviction is frequently penalized by the architecture of the system itself.